Good afternoon, everyone. Welcome to another webinar of Axis Mutual Fund. I am Rahul and I am your host for today. Today we have a very special guest with us, Mr. Hariharan. He has been there with us from 2020. He heads the L&D segment or the Learning and Development segment for us. Welcome, sir.
Thank you.
We have recently launched an NFO, Axis Nifty Bank Index Fund, and sir will be taking us through it.
Thanks, Rahul. As Rahul mentioned, Axis has recently launched the Nifty Bank Index Fund. I will take all of you through a very quick presentation on this, and of course, if there are any questions, we will definitely try and address those questions as well. This NFO has already started on the 3rd of May 2024 and will be open till 17th of May 2024. When we talk of index fund, let's quickly first of all understand why do we look at the Nifty Bank Index in the first place. Just to give you some data points, if you look at the Nifty 50 construct, you will find that the financial services as a sector constitutes the highest weightage. About 34% of the weightage in the Nifty 50 is of the financial services. And if you can actually look at from the year 2014 onwards, you will find that this has gone up from 27% to 34%. And that's precisely what an index is supposed to do. It is supposed to sort of tell what the economy is, where the economy is going and what sectors of the economy are actually driving this economy. So I think from that perspective, it is very evident that the financial services and the banking services as a sector is one of the biggest market drivers in India. If we go ahead and understand what is the opportunity that lies when somebody were to look at a banking and a financial service industry, clearly it is the under-penetration. Now, what do I mean by under-penetration? If you look at the household debt to GDP ratio, currently it is at about 37%. And if you can compare it with some of the world economic, big economies, like UK or the US, you will realize that the ratio is pretty low. Now, what does it mean, from a banking perspective? It is like this, you and I as individuals typically tend to take credit in the form of loans. So if this ratio is low today and one would expect that this ratio would go up in the future, it means that more and more people will buy home loans and personal loans. What it means for the bank is that the bank will now be able to earn interest income, and I think that becomes the crux of the banking industry. Secondly, as more and more people start taking credit in the form of loan, it also gives banks an opportunity to cross-sell multiple products in the future to the same customer. I think from that perspective, there's a long-term growth opportunity that exists, from that data point. If you look at the corporate, the corporate debt to GDP ratio is also at 55%, which is again one of the lowest when you compare it with major economies in the world. And if you go back to 2020 when the COVID episode happened, a lot of corporates and companies did what we call as deleveraging. What is deleveraging? Essentially, they paid out a lot of their existing loans, and today they are sitting on a very low amount of loans or borrowings. And given the fact that we have been hearing about the India growth story and how private capex is going to sort of drive this story going forward, banks will be in a better position because a lot of corporates and businesses would want to take loans to fund their expansion. I think from that perspective also, there is enough opportunity for this segment and the banks to grow further. To sort of sum it up, if you look at the mortgage percentage of the nominal GDP, again, that ratio is pretty low in the country, which is at 11%. And again, from the potential, you can easily look at major economies, and there's enough scope for this to sort of multiply in the immediate future. From a performance perspective, if you look at how the Nifty Bank Index has sort of delivered, it is clearly one of the biggest wealth creator story in the country. Just to give you some perspective, if you look at the data, you will find that from 2000 to 2024, so it's a 24-year data, you will find that the Nifty Bank TRI, so TRI is the total returns index, has delivered about 18.76% as compared to the Nifty 50 TRI, which is delivered about 13.38. So there is clearly a differential about 5.4% per annum that the Nifty Bank TRI is generated above the Nifty 50. Again, to add some color to this data, if one would have invested a lakh of rupee in the Nifty 50 way back in 2000 January, this 1 lakh would have become about 20.4 lakh rupees. On the other hand, the same 1 lakh rupee invested in the Nifty Bank TRI would have become 61 lakhs. So clearly there's a difference of almost 40 lakhs. If I look at from a multiplication perspective, the wealth creation is 3 times with a Nifty Bank TRI as compared to the Nifty 50 TRI. As we talked about the past performance, if you look at the rolling returns performance, again from 2000 to 2024 across different time periods. So what is evident clearly is again that the Nifty Bank TRI has outperformed the Nifty 50 across all these time periods, which is 3 years, 5 years, 7 years and 10 years. Importantly, just as we saw in the previous slide, the differential was about close to 5.4%. You will see that across all these time periods also, the alpha, the extra returns that the Nifty Bank TRI is generated as compared to Nifty 50 TRI is again in the range of 5 to 6% per annum. And just add compounding to it and you will realize the kind of wealth that can get generated. If I were to sort of extrapolate and dig deeper into this data, it shows that, if you look at a 3-year period, 70% of the time on a rolling basis, the Nifty Bank TRI has outperformed the Nifty 50. And as you go longer in terms of the duration, so you go to a 10-year period, you see that 98% of the time the Nifty Bank Index has outperformed the Nifty 50. So clearly this is a long-term wealth creation story that the Nifty Bank Index sort of offers. Again, from a calendar year perspective, just to talk about the performance on a calendar year basis, out of the last 10 calendar years, Nifty 50 vis-a-vis the Nifty 50, the Nifty Bank Index has delivered superior performance. And again, you can look at the kind of outperformance across these years. Now, the important question that comes to mind is, while Nifty, the Bank Nifty has delivered very good performance, market is at a very high level, and therefore does it make sense to invest or look at a Bank Nifty index? To sort of address that question, let's look at the valuations. If you look at all these 3 parameters, whether it is the price to earning or the price to book or the return on assets, you will clearly see that they are reasonably valued. So let's take each one of them individually. When you look at the price to earning of if you look at the 10-year average of the Nifty Bank, you will see that the average is about 15-16%. Currently it is at about 15-16%. The average, long-term average is about 24-25%. So clearly from a valuation perspective, it is clear that the banks today are, if I can use the word cheaper, they are available cheaper today. If you look at the price to book, the long-term average is about 2.77. Currently we are at 2.77. The long-term average is about 2.72. So almost at par to the historical averages, which gives us a feeling and a sense that it is not overvalued. In fact, on a price to earning ratio, it is currently undervalued, and that is where the opportunity lies. On the return on asset parameter, essentially you'll find that it has increased from about 1.4 to about 1.7. While it is marginal, but it does give us a sense that banks are now efficiently using the assets. Let's look at few more data points. We talked about how the Bank Nifty has performed vis-a-vis Nifty 50. Let's look at a quick comparison vis-a-vis some of our developed country economies, in terms of how they are banking versus how our banking is faring. So if you look at the NIMS, NIMS is essentially the net interest margin. Now what does that mean? You and I go to a bank and suppose we do a fixed deposit. So when we do a fixed deposit, the bank gives us interest. On the other hand, when you and I go ahead and take a loan, the bank charges us interest. So essentially this difference between what the bank earns as an interest versus what the bank gives us as an interest, that difference is called as the net interest margin, or the NIM. And if you look at carefully in this slide, you will see that in the case of India, the NIMs are far superior as compared to most of the other countries. We are talking of a NIM of 3.7, which means on an average the banks are earning 3.5% more as an interest vis-a-vis what they are borrowing. Similarly, when you look at the cost to income ratio across major banking markets, you will find that India is sort of placed somewhere in the middle. So we are far better off again as compared to most of the banking economies. So again, from a global perspective, I think Indian banks are in a fairly safe bet or a safe place. From a balance sheet perspective also, if you look at some of these ratios, the most commonly one that is referred is the CET1 ratio, which is the Common Equity Tier 1 Capital Ratio. And if you look at it again, this is a regulation from the RBI, and you can clearly see that the trend is encouraging in the sense that the Tier 1 capital ratio is fairly strong and good in the economy, which also gives us a sense. So when you look at CET1, it is essentially a measure of the measure of the good quality capital that banks have vis-a-vis the risky asset like a loan. So it in a way tells us what is the financial health of the bank. And when we talk of health, I think one of the quickest analogy that one could think about is most of us would have done a lipid profile test. And in the lipid profile test, you get this good cholesterol versus bad cholesterol and total cholesterol. So if I were to sort of correlate both of them, the CET1 ratio is sort of telling us the good cholesterol which is there in our lipid profile as compared to the total cholesterol. So just like a good number in terms of the good cholesterol, so which is represented by the high density lipoprotein, which is HDL, as the more the HDL, lower are the chances of the heart failure. Similarly, higher the CET1 ratio, lower is the chances that the bank could fail. So from that perspective, it's quite evident that Indian banks are in a pretty safe position. On the other hand, when we talked about deleveraging that is happening in the corporate level, what has also happened in the banking system is there has been a complete revamp. I'm sure most of us would have been hearing all these news over the last so many years, how the banking system has sort of got cleaned up. Now, how do we get to know that? It is essentially from these numbers, which is the gross NPA and the net NPA level. So if you look at the graph, again, you find that the NPA levels have sort of come down drastically, which again tells us that Indian banks are in a very healthy condition and a very healthy state. From the demand perspective, if you look at, we have been seeing reasonably good credit growth, while the deposit rates have sort of softened, but the credit growth remains very, very strong. And I think that's very, very critical from a banking perspective. The more the banks lend, the more money they make, right? What has also added to the fact is that, we have seen the participation of retail in the sort of bank credit has gone up. Again, that's very important. So unlike a corporate, individuals and retails, while the number of accounts could be large, the ticket sizes are relatively lower, and therefore from a delinquency perspective, the defaults could be much, much lower in terms of the impact. I think that's a good sign again that the share of the retail credit has gone up in the bank credit. So net, if you were to look at it, the health of the bank is superb in terms of some of these ratios and parameters. Another interesting thing that has happened in the country is the way digitalization has happened. And I'm sure all of us could relate to this. Before COVID and after COVID, I know most of us would have been transacting in cash earlier. Today, most of us would be dealing with some of these UPI payment aggregators. And that's again evident in the graph that you can see. The trend of retail digital payments has sort of rocketed in the last few years. Same is the case with UPI transaction, both in terms of volume and in terms of value. So today, if you look at it, close to 40% of all the digital transactions in the world is happening in India, right? If you look at the digital banking maturity, which is essentially the acceptance of digital across different segments of the banking, again, you find that India has been growing by leap and bounds. Just to look at some of these numbers, the score that the Indian banks have got in terms of mobile banking. So we have scored 3% more as compared to the global average. Similarly, in the case of internet banking, we have scored about 1% higher. In terms of account opening, the difference is pretty huge, close to about 16%. So net-net, digitalization has been accepted widely in the country today, and that's also helping the banking industry to penetrate significantly in India. We talked about the NIMS. This is just a quick trend, of how the NIMS have sort of improved across most of the large private banks and the mid-sized private bank players, right? What has also aided them is the fact that we have seen that the interest rate cycles have gone up. So we have sort of reached the peak of the interest rate cycle, and that has added to the net interest margin. While there are now talks of RBI reducing the rate sometime in the future, please remember that this NIMS could get compressed to some extent, So having discussed about the banking industry and how the growth is expected to happen in this industry, let's come to this topic of the Axis Nifty Bank Index Fund. And as I said, we talked about the bank index. Let's understand this in more detail. So the Nifty Bank Index is essentially going to sort of tell us what is the performance of the Indian banks. It's going to sort of capture the capital market performance. Now, how is this index constructed? So it will have the 12 most liquid and large banks which are listed on the National Stock Exchange. This index was constructed in September 2003, and if you look at the top weightage of the stocks, 29%, the top 5 stocks weightage is about 80%. Importantly, if you look at it, only those companies become part of the Nifty Bank Index which are also traded in the derivative segment, which is the future and options segment. And this is going to be rebalanced on a semi-annual basis, which will be January and July. Just to sort of get deeper into the index constituents, the highest weightage is with HDFC Bank. And importantly, you also look at some of these weightages which are pretty low, which is 1% with Bandhan Bank and about 1.8% with AU Small Finance Bank. So essentially what we are trying to tell you is that this index is going to have a mix of the largest but the most liquid ones, okay? And if you look at the market breakup, you will find that close to about 93% is large cap and about 7% is mid cap. Again, from an ownership perspective, you get a nice mix of private banks and PSU banks. Now, why this is important, as I started with, index is supposed to sort of replicate what is happening in the economy. So if you look at 2003, PSUs dominated this index with 70%. As we come to 2024, it's sort of reversed, and we have roughly about 84% which is private banks and 16% which is the PSU banks. Now the important question, why should one invest in the Axis Nifty Bank Index Fund? First and foremost, as we talked about, the bank and the financial services represent 34% of the economy, and therefore by participating in the Nifty Bank Index, you are sort of getting the benefit of the economic growth that is expected to happen. No economy can flourish without a sound banking and financial services, and therefore from that perspective, as we talk of India multiplying the GDP in the next few years, I think all of us as investors stand to benefit out of this. Two, we already discussed about the price to earning ratio, the price to book, and therefore from a valuation perspective, the bank index is reasonably valued, or without being overvalued at this point in time. Three, an index constitutes the 12 most largest and liquid stocks, and importantly, there is a rebalancing that will happen every 6 months. So what it means that some banks could move out in the future, will get replaced with some other banks, and therefore from the style perspective, you get a very consistent top 12 banks, in terms of liquidity, in terms of the free float that's available. And of course, one of the important questions that people generally ask, again related to market, is it a good time to invest? And from that perspective, from a valuation perspective, definitely it is currently fairly or undervalued. So from a potential perspective, there's a lot of wealth that can get created. Again, for people who might worry about making a lump sum investment, the index fund offers the benefit of doing SIP investments, right? Some of the important scheme details, as I already said, the NFO is open, so you get units at the face value of 10 rupees. The benchmark is going to be the Nifty Bank TRI. You can invest with a minimum of 500, and Karthik and Ashish are going to be the fund managers. So with that, I think, Rahul, I will stop here. If there are any questions, we'll try and address those questions.
Thank you for the great detailed and I'll say such in-depth analysis of the Axis Nifty Bank Index Fund.
Thank you.
Now we'll do the questions. We have a couple of questions from our audiences.
Sure.
We'll take them up one by one.
Sure.
So, we have been talking all this while about index funds and Nifty Bank Index funds. What actually is an index fund?
Okay. So index fund is essentially a passive mutual fund which replicates the underlying benchmark or the index. So the fund manager will try to replicate the underlying benchmark or the index. So it's a very passive way of investment.
And how does an index fund work?
So as I said, so let's take an example, let's for the time being move away from banking and move to a Nifty 50 as an example. So when you look at Nifty 50 index, there are 50 companies in the index. So what the fund manager does is that he will buy the same 50 companies which is there in the index and in the same weightage and proportion as is there in the index. So he's essentially sort of copying or mimicking that index. So that's how the fund manager creates and constructs the portfolio in an index, and that's how the index fund works. So as the value of those underlying goes up, the value of the index fund also keeps going up.
Okay. And now coming to the crux, what are the benefits of investing in mutual funds for a person like me or who's my age? How do I choose the right index fund for me?
So you're asking, if you can repeat the question, the first part of your question?
Yeah. What are the benefits of investing in mutual fund?
You're talking of index fund specifically?
Yeah.
Okay. So good question, so when you look at index fund, one of the biggest advantage that index fund offers is it's low in terms of the cost, because the fund manager is passively managing the fund. So for the fund management charges are pretty low, and there's a capping to the charges, in terms of the index fund. So it is one, low in terms of the cost. Two, it also offers you diversification. So by participating in the index, you are basically participating in that entire set of, or the universe of stocks, which are there in that index or benchmark. So from that perspective, I think, these are beneficial. The second part of your question was pertaining to...
how do I choose the right index fund?
Okay, so again, an important question. How do we choose an index fund? Because typically it's a passive style. So by and large, every fund will have, every passive fund in that particular, using that benchmark will have the same component or constituent. And therefore, from that perspective, there are a couple of important points. One is you look at what is called as a tracking error of the fund. So tracking error means that a fund is supposed to replicate the index. How well is the fund actually replicating the index? So tracking error is an important parameter to look at when it comes to index fund, and lower the tracking error, better is the fund. So one is to look at the tracking error. Two is to also look at what is the kind of flexibility. When I say flexibility, please remember that while the fund manager will try his best to replicate the index, there could be some delay or lag. So it's important to consider the efficiency with which the fund manager is able to sort of replicate that index on a real-time basis.
Okay. And what could be some of the risks associated with index funds?
Okay, so when we talk of risk, because it's an index fund, and predominantly since you are now talking about equity-based index fund, the risk comes by way of the market risk. When I say market risk, because of certain events in the market, the price of the underlying stocks which are there in the benchmark could get impacted positively or negatively, and therefore from that perspective, one could face a capital gain or the capital loss. The second is what I talked about as the ability of the fund manager to sort of replicate the index. So the tracking error is another important sort of risk that one needs to look at. Liquidity, I'm just making a very general statement, assuming you are getting into index funds which are pretty liquid. So the liquidity will not be an issue, but certain categories of index fund one needs to be mindful of the liquidity element as well. So these are some of the risks that generally comes by investing in an index fund.
Okay, that's a great detailed, I'll say, analysis or like an description for me. So, how do these index funds manage to keep their costs low?
It's very simple because you're passively managing the fund. So when you compare this with an actively managed fund, the fund manager does a lot of research, is supported by a team of research analysts who sort of day in and day out analyze businesses, their reports, and then they submit the report to the fund manager, who then uses his wisdom to sort of decide on which stocks could become part of the portfolio. So there is an effort, there's a time that's involved, there's a cost that is involved, which does not happen in the case of passive, because the fund manager has to just sort of replicate the existing index. So he does not have to worry about which stocks do I purchase, which stocks do I sell. So he essentially has to just mimic and copy. As and when there is a change in the underlying index, he has to just sort of make those changes in his portfolio as well.
Okay. So, like, can I lose my money also by investing in index funds?
Well, yes, that is because it's ultimately invested in the, again, from the current discussion perspective, you're talking of stock markets. It's invested in the stock market, and as I said, there could be market events, there could be other events which could sort of impact the performances, and therefore there is a possibility that if the underlying stocks in that portfolio don't do well, the market does not do well, there's a correction in the market, there is a possibility that the investor could also lose money. But to give a caveat or a general statement, it is generally found that if you stay invested for longer periods of time, the probability of losing money drastically reduces. And from that perspective, I think it's important for investors, when they come to equity, whether it is actively managed fund or passively managed fund, one should definitely look at a long-term investment horizon.
Okay. And so as everyone says that you need to diversify your investments and all, or do the correct asset allocation, how do index funds fit into my overall investment strategy then?
Okay. Now again, what is normally suggested, again, because if I can sort of preempt another question here, it is that is active better or passive better? So in a way, this sort of also addresses that question. My sense is that there is scope for both of them. The quick corollary that comes to my mind is, if you look at the 15, maybe 20, 30 years back, you had only manual driven cars, right? So when you're driving a manual driven car, you are basically, as a driver, you are very active in terms of changing the gears, and switching between the gears, etc., so on and so forth. We then had a situation where we had manual plus auto transmission cars. So the auto transmission is sort of a pseudo active or the pseudo passive, because you're now focusing only on the accelerator and the brake. You're done away with the gear changing system, right? Today we have some vehicles, especially the SUVs, which also have cruise control, and especially when you go on highways, and assuming the highways are empty and the roads are smooth, you just set the speed, you just control the steering, that's it. Rest of the other thing is all done automatically. So in a way, in a car you have auto as well as manual and maybe even cruise control. Similarly, in a portfolio, from a portfolio perspective, you should have active and passive. Now the composition generally could be looked at in two ways. So one could be that I could have close to about 70-80% of my portfolio which could be actively managed funds, and the balance 20-30 could be about could be passive investment. Or one could also reverse the ratios and say that I could have 70-80% as passive investment and 10-20 as actively managed funds. So we call this as the core and satellite approach in portfolio management.
Thank you, sir. That was, I think that pretty much sums up all my doubts and queries regarding this NFO. Thank you everyone who joined us today. Please do subscribe to our Nifty Bank Index NFO.
Thank you all of you for joining for this webinar. I'm sure we would have understood what is an index fund, and most importantly, what is the Axis Nifty Index Fund all about. Please do subscribe to this fund. It's a wonderful opportunity for all of us to create wealth in the long term. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.